Thank you all for being here. I'm remiss to not be able to do this in person, but I think the great benefit is we're reaching a much wider audience today. I'm very privileged to have three fantastic panelists today. The format will have about a 40-minute panel discussion, and then we'll follow up with about 10 minutes of Q&A. So if you have questions, I've got a panel pulled up right now on the side of my screen, so I'll be looking at questions that are coming up. The more questions, you can vote on them. So if you see a question on your panel that you like, this is the panel on your screen, you can click on it. Those that rise to the top will be ones we'll work with today. So without further ado, I'm very excited to welcome these three panelists. We have quite a number of years of experience in the industry, as well as a diverse set of skills, starting with George Petrie. George, if you want to wave to the crowd for those who don't know you. George is an industry veteran, CEO of Goodman Real Estate. George has worked on the development, acquisition, disposition, and capitalization over 350 assets. In just this market cycle alone, George has either developed or renovated over 10,000 units. To George's right, I guess, depending on your screen, is Walt Smith. Walt is the CEO and founder of Avenue 5, a national property management firm based here in Seattle, Washington. Walt is on his third property management firm, first founding HSC Real Estate a couple of decades ago, which grew to 34,000 units before it was bought by Riverstone. Walt served as the CEO of Riverstone and later to found Avenue 5. He has grown it to tens of thousands of units since 2015 and has a national footprint and is a true expert in his field. And then finally, we have Alex Mundy here at Kidder Mathews. Alex is a consummate expert in lending, both with existing assets and development. Alex comes to us with more than 10 years of industry experience, 6 years in direct lending, as well as appraisal before that. So we're gonna do a round robin of questions, have a lively discussion today, covering a multitude of topics focused on multifamily. 2020 has been an interesting year, to say the least. We're not quite through it yet, but we're enough months into Corona to see some of the impact. So I'd like to focus starting on operations right now and direct some questions to Walt. Walt, kind of a broad question. What have been the biggest impacts in your portfolio managing apartment buildings since really Corona came to light in March of this year?
Good morning, everybody, and thanks for having me, Dylan. This is my third company. It's my last, just to make sure that's clear to everybody. I won't be doing any more. And we manage about 72,000 units in 13 states and the District of Columbia. Over half of them are on the West Coast in Washington, Oregon, and California. We manage just under 13,000 units in the Pacific Northwest and in Western Washington. And then another 5,000 units or so over in Eastern Washington, and a good size 12,000 unit portfolio down in Portland. So we have a lot of data to choose from and a lot of experiences that we've been working our way through since early March. You know, I would say the first and most important aspect of operational challenges was when we closed our offices at all of our properties. We'd never done that before, and that happened in the middle of March. And they were closed until, depending on where they were at, sometime in May. And then they were opened on a limited basis to residents and prospects. It started out just being residents. And when I say offices, I also mean common areas. So rental offices and common areas, for the most part, were shut down for a couple of months. And now they're open in different degrees depending on where you are in the state and which county you're in and what phase they're in and those types of things. You know, I would say the number one thing that has changed substantially in our business and in the industry is the virtual leasing aspect of our business, where it was probably 10 to 14% of our leasing was done without meeting the potential resident, without having them come to the property. And that number is now a solid 30%. And so, it's basically tripled over the course of the last 6 months. And then you throw in self-guided tours, which it's another, depending on the property, let's just call it an average of 25 to 30%, probably not quite the virtual leasing number, but a lot of self-guided tours. And we've set up systems, we've utilized suppliers that have different products for self-guided tours. And then we started a couple of months ago doing in-person touring again, for the most part. And it is 30-40% of what's happening, depending on which submarket you're in. So obviously that's a huge shift. And so it changes your marketing programs. It changes the way that you look at leads, just to say, what is a qualified lead these days? It is substantially different than it has been in the past. And we sit around and talk about, what should we qualify as a lead? Is it a click? Is it somebody, you have to get somebody on the phone? Is it a website lead? Is it an email? So, going through all of that data and trying to come up with a way of measuring performance other than just pure leasing statistics, because still where the rubber meets the road is, how many leases am I getting on a weekly basis or a daily or monthly basis? And I would say that we've been pleasantly surprised with leasing. We thought that it was going to be down substantially more than it has been. And in the first 2 or 3 months of the crisis, the diminished leasing was actually keeping up with your occupancy needs, because hardly anybody was moving out. And by this, late spring, early summer, that changed to where people felt comfortable enough to move. And then we needed to lease more. And so I would just say that, getting enough qualified traffic through the virtual door, the self-guided door, or the actual leasing door has been and continues to be, I would say, slightly more challenging every week in Western Washington to keep up with the turnover that we're having, and to deal with one of the main factors in the market is home purchases. So, in the B and A product, home purchases are a major factor. And so let's say that net migration into the region is somewhere neutral-ish, but you have a fairly large number of people purchasing homes, that there's certainly pressure on occupancy. And we'll get into that in a little bit, but coming up with creative ways to deal with occupancy is a major challenge in our operations. Also, paperless leasing, so sight unseen leasing, and that number has over doubled to a little over 50% of our properties, and many properties have gone completely paperless. Helping residents find help to pay their rent. That's another major factor that we have going on, coming up with creative ways, finding charitable organizations, helping people figure out how to get government assistance and helping them, during the process of setting up payment plans and that kind of thing. Work orders, whole nother issue. When is it reasonable to go into somebody's apartment to do a work order? For the first 2 or 3 months of the crisis, we weren't going in unless there was a flood or a fire or, an appliance that was not working. And now it's a little bit more normalized, but it's still coming up with protocols for going into occupied units to do work orders has been a whole nother challenge for us. The tracking of every dollar that's collected at the sites. You know, I would say that we did a pretty darn good job of it in the past, but it was an income stream that was much more reliable 6 months ago. And now the income stream, although it hasn't diminished like we thought it was going to, you know, there's this great unknown out there. So we're literally tracking every dollar every month of rent and measuring month over month, comparing it to last year, comparing it to March or February or April, and you know, trying to track and try to understand where we're headed is a challenge, and we'll talk about that a little bit later here too. So I think I've hit on enough there, Dylan.
Yeah, thank you very much.
Yeah.
George, can you give a sense of sort of the number of units you guys operate and manage in the Pacific Northwest, and how you guys have been handling just operational changes, you know, very similar to Walt in this changed environment, how you guys are attacking that?
Yeah, Dylan, you know, number one, thanks for hosting this. I think it's timely. Two, I think that, you know, for us, if you had to kind of break it down, somewhat similar to what Walt was saying, but slightly different in that, you know, I think the opportunity to develop a compassionate response to those who simply were unemployed or truly impacted by COVID, yet balancing that with accountability. So we've had to navigate just what is the right response, regardless of the eviction moratorium. We also, one of the things we did put in place was a collection/billing department, one that had to navigate that compassionate, accountable response, which we had not had. And now we have 4 people who are actively working with every resident as they step forward and say, hey, I really can't pay, I really don't have it. And I think that's been helpful in helping them navigate all of the programs that Walt was describing, and at the same time giving them some sort of, you know, housing security and understanding around that it is a relationship that continues onward beyond the COVID crisis. And we're optimistic that of the 1,700 people that haven't fully paid their rent as of today, that most, if not all, will find solutions, of which we'll be a part of it. So that's been a big one for us. I also think that virtual leasing is a big one. We had to take it all virtual within 3 weeks. We successfully did that, and we have some of the similar statistics and examples that Walt is painting a picture of. You know, tragically, we had to cut our CapEx for 2020. I mean, fundamentally, we cut out a whole bunch of jobs that other third-party vendors would have done. And, you know, that I feel a little bit bad about that, because those are people who are probably struggling right now to make ends meet. And that was one of the tragic challenges of this entire experience. And even in our construction divisions, we've had real challenges keeping people on site, employed, running at full steam for all sorts of different reasons. So it's impacted not only us, but probably the economy. And then, you know, finally, one thing we did do is we targeted 100% occupancy and said, let's get to 100% occupied. Let's fill up every single unit at whatever quote unquote rental rate we really think we can get. And that has been a successful strategy in order to offset some of the losses that we're anticipating, and also provide shelter for those who are truly struggling. And I think those strategies have been working well for us from an operational perspective.
Thank you, George. And those points, both made by Walt and George in the end, are really interesting, because most market cycles, you see a shift with an inflection point, and the first thing you lose is occupancy. And then from there, you start to see rent declines. With COVID, we didn't see a loss in occupancy because there was an eviction moratorium and people didn't want to move around. I think the spike we saw was in collection loss, and it wasn't nearly as high as we thought it would be, but buildings were staying full. But what we're seeing now is we're working our way through without more of a federal response of assistance. Here we are in September. Walt, turning back to you, where are you seeing, you know, I think what we're seeing now in the market is some more vacancy, having to backfill those units, and there's a focus on collection loss, but now we're really putting an eye towards rental rates. Where have you seen rental rates actually increase or stay flat in your Western Washington portfolio versus declines?
So I would say the first thing that you have to measure when you're looking at rental rates is why would they change? Why would we need to change them? What are the pressures that are causing you to make those changes? And just to touch base on the comparison of Seattle to other, or Western Washington to other submarkets. we've collected today 92.11% of the rent that was due this month. And compared to last month, that was 92.46. So it's down a third of a point. Not substantial, but certainly noticeable. If you compare it to other markets, the number one market for us is Colorado at 95.76. And the second one is Phoenix at 95.91. The third is Utah, Salt Lake area at 94.73. The fourth is Texas at 94.38, and then Seattle at 92.83. So we've collected just under 93%. And we've been collecting in the Seattle market around 96% by the end of the month of the rent that is due. The other thing that we track is what's happened with the whole. What we're using percentages of rent here. Well, has that total number gone up, down, stayed the same? And in the Seattle market, it surprisingly has stayed fairly similar, and I think that's to do with the dynamics of our portfolio, which is a pretty good mixture of urban and suburban, where rental rates in downtown Seattle and downtown Bellevue and occupancy, so occupancy and rental rates in downtown Seattle have gone down, obviously. They have, in downtown Seattle, they are down probably 4 or 5 percentage points, somewhere in that range. Downtown Bellevue, 2 or 3 percentage points. And overall rental rates have gone down more than that, you know, especially on the higher end. They've gone down in downtown Seattle on the higher end. B&A product has gone down between 10 and 15%. And that most of that's happened since the 1st of June. And in Bellevue, a little bit less than that. But conversely, the suburbs are doing better. Occupancy's actually ticked up, and rental rates are pretty darn stable. We aren't putting out any rent increases to current residents, I don't think, anywhere. And if we are, it's very minimal. So it's on turnover. So we're getting some rent increase on turnover. And that's happening out in the suburbs. And it's, I would say, in the eastern, on the east side is where most of that's happening, but also down in Thurston County and Pierce County, you see a reasonable amount of rent growth going on down there, all things considered, you know, so let's say it's 1 or 2%. And so that seems to be offsetting what's happening here in these core markets.
Real quickly on that, Walt, are you seeing a converse effect with the more affordable markets where there's actually some rent growth but higher collection loss in those markets?
Yeah, you know, I wouldn't say that we're seeing much, if any, rent growth, but and it's surprising the difference between our collections with the A product versus the C product. As an example, today it's, you know, 92 versus 86, so roughly a 6 percentage point difference in the amount of rent that's been collected, and that number by the end of each month narrows because we have a lot of payment plans, and we have people that, you know, that are late in their payments, but they're making those payments, and it ends up being about a 3 percentage point difference between the higher end and the lower end as far as percentage collected. But I wouldn't say you'd see any we're not seeing many rent increases, Dylan.
George, across your portfolio, how are you dealing with the sort of the dynamics of maintaining occupancy and as well as rental?
Yeah, that's a good question, Dylan. And I think that I'll break it up somewhat similar to Walt. We do have a portfolio in the Midwest, and we're collecting about 98% of that. So think Minneapolis area. In Texas, we're collecting about 97%. In the Puget Sound region, which we have about 8,000 units here, we're collecting about 94%. This month, I will tell you that we've actually had an ounce of a deterioration. And I was wondering if it was going to start to show up since the unemployment benefits had kind of ended. the CARES Act benefits had kind of ended, and we were wondering if we would see a difference between August and September. And we've actually seen a little bit of an erosion. So it remains to be seen if it gets worse or if it's stabilizing. Our accounts receivable has been growing at about $450,000 a month. So there's a group of people who simply cannot pay. I don't think it's elective non-payers. There may be some in there, but I don't think it's a lot. I think flat out there's 67 people who owe over 7.5 months rent, and they've never paid. So how do you navigate that? Well, you work with them. We have 861 people who owe less than $430 each. So over, about half of our 1,700 owe something that is less than 1 month's rent. So there's definitely a bifurcation going on between the ability to have people pay and their ability then to not pay at all, just flat out. So that government assistance, I think, is going to end up being pretty critical in solving that challenge. I was working with some numbers recently for another group, and we kind of speculated what's the impact at the state level on the number of the outstanding total balance due potentially in the universe for all housing providers. And we came up with that by the end of the year, we'll be at about $700 million for all landlords. And by March 31st, which I'm kind of thinking that maybe this moratorium gets extended all the way till then, tragically, in many ways, until we find a solution, it could be as close to $1 billion. So this is a real number, it's a big number, and I'm optimistic that we can work through it at the state level. And when it comes to actual rent increases, the existing resident profile, we aren't increasing rents at all, literally in any state. And with units on turnover, we're seeing a tad bit of rent growth in some suburban product. We are not seeing rent growth in urban product, specifically Seattle and specifically Minneapolis. And Seattle, we have one asset that's now at about 76% occupancy, and rents are down 32%. And that's Class A. So this is real, this is material. And I don't think and we're giving 1 month concession right now. Maybe we should increase our concession to 6 months, and maybe our rents will be closer to market. So I'm not sure. It's just a really rough market right now. People don't want to live in Seattle right now. I just think that this market is going to be pretty rough for a little while.
Excellent points, and appreciate the data digging into your portfolio, George. Turning to you, Alex, we've got a lot of lenders out there looking at new acquisitions, looking at refinances, assessing risk in their portfolio. How are lenders looking at rent versus occupancy versus collection loss? How are they analyzing the market, and where are they getting their data?
Yeah, I think that's a great question. It's probably the biggest change that I've seen in this part of the cycle is how lenders are looking at collections. So I think across the board, whether you're talking about agencies or life insurance companies or banks, they're really scrutinizing collection losses. And the question I always get every package that I send out is which tenants are paying, which ones are not paying, and what are the outstanding delinquencies. And I think that's going to be a question that we're going to have, especially through the end of the eviction moratoriums. And the way lenders are approaching it is, if a tenant's not making their payments, then that's a vacant unit. So if you have a 100-unit property, 5 units that are vacant and 5 units that simply aren't paying, the lender's going to underwrite that as a 10% vacant property. So it affects proceeds, it affects your debt service coverage ratio, and it's important, especially on acquisitions where buyers are trying to get max dollars. As far as the data question, the best source of data that lenders have is their own portfolio. So, Fannie and Freddie have hundreds of thousands of loans. They're looking at the annual reports that they're getting from clients and seeing what are the collection losses. And banks and life insurance companies that have large national portfolios are also tracking that really closely. I think there's more scrutiny on appraisals as well. And lenders are just getting any source of information they can, whether it's Mathews market studies or their own data or CoStar or Reese or wherever.
Thank you. One thing that George said at the end of his last response was really renter preferences. And I think we've seen a huge shift in a very short period of time of what's preferred. Walt, I know specifically properties you have in your portfolio. They're well amenitized. They've got beautiful club rooms, roof decks. How are you handling, are you opening any of those? Are those properties that were preferred in February of 2020 now less preferred? What are you seeing across your portfolio with the use and the opportunity to have amenities?
You know, most of the common area amenities are open with the number one exception of gyms. We have some open, but we are following the governor's guidelines where you pretty much need to have an attendant to open a gym. If we have a large gym, I mean, we're certainly keeping occupancy low, and we are following the guidelines. But other common area amenities that have really shown, and they were popular before, but they're even more popular. If you have common area amenities that allows people to work, if you have you know, WeWork type amenities, and even, you know, rooftop decks when the weather's nice, club rooms that allow for social distancing and people to be able to work there. One of our biggest priorities has been improving internet service, and it's challenging in a lot of these buildings, as many of us know, that to get good coverage. And what we thought we had good coverage before, and all of a sudden you have people working from home all the time, the coverage, that obviously we don't have enough capacity. So things slow down, people aren't happy. We have been working diligently to improve our internet capacity at virtually all of these buildings. And then I would say the other thing is that if you happen to have a newer building with any form of touchless technology, you are one step ahead of the game. So if you have a mid-rise or high-rise and you have keyless entry, you have the ability to control your elevators without touching buttons and that type of thing, I mean, you are one step ahead. And we certainly are working with our clients in regards to technology to spend wise capital dollars that will make sense 2 years from now when the pandemic is over, that people will enjoy when we are working with developers on new projects, or they're trying to figure out how to cost effectively improve their operations so that there can be a little less interaction, excuse me, with the staff. Touchless technology is obviously a real hot button out there right now.
I'd say living in the Pacific Northwest on days where the air quality is, I guess, less than 300 parts per million, the greatest amenity we have is the outdoors. Walt, have you seen a shift more suburban versus urban specifically that you've been able to equate to just using the outdoors as an amenity, maybe Issaquah as an example, or Redmond versus someone wanting to be in downtown Bellevue or Seattle?
Yeah, so I mean, is it the Seattle versus Bellevue question? Is that what you're really getting at there, Dylan?
Yeah.
Yes, I can tell you that the suburban markets where there's less density, obviously, people are moving in that direction. And you know, the other factor is people being allowed to somewhat permanently work from home. So you can't say that isn't a major factor, because it is. And a lot of the renter profile is pretty doggone mobile. And so we have people saying, you know what, I know I don't have to go back to the office till at least next summer, so I'm going to move for now, and maybe I'll have to move back, maybe I won't. So we have seen occupancy in certainly on the east side suburbs, Issaquah, from Bothell all the way down to Newcastle, and out to Redmond. We have seen stronger leasing and stronger demand out there, but you know, it's still challenging in those markets because those are big home purchase markets. So we're losing people to home purchase out there because let's say 20 to 40% of them were renting by choice to begin with, and they have the ability to buy a home, and so you just see a lot of people doing it.
Well, your office is in downtown Seattle. Are you getting requests from staff members to to look at other locations?
Well, so our corporate office is downtown, and our occupancy was about 70 people in here every day prior to the 10th of March, and we haven't had more than 7 or 8 people in here since on any given day. You know, between people's concern about, you know, the long-term concern of riding transit, riding the bus, taking the train, you know, all the reasons that we moved down here. You know, the access to affordable transportation down here was second to none around the area, and I don't think that's going to change long term. But you know, that the reasons that we came down here was to be in the business district and to be in the core of the activity. And right now that is absent. I still have long-term faith that, you know, by the summer of 22 anyway, I'm going to feel like I'm probably going to feel better about our location. But there's no question, I know a lot of people that are contemplating moving to the east side. We all do. I can't tell you that I'm in that boat just yet, but there's a lot of answers that we're going to have to come up with before we make that decision.
George, Goodman Real Estate's a Seattle-based company. Your office is in Seattle. I think last year you sold your last office building that you owned in Seattle. It's all multifamily now. How are you guys looking at in underwriting being east versus west?
You know, Dylan, it's just tragic. You know, born and raised here. And, you know, you just look at the condition of the city. It's about leadership or lack thereof. I mean, it's a mess downtown. It's a mess. And I think it's self-inflicted. You know, maybe it's shame on me because I didn't do more in the political arena. Maybe it's, you know, maybe Dylan and, you know, Walt and Alex, maybe all of us should have been doing more. But at the end of the day, that's where we're at. You look at the city council and it's a mess. So we over time, we've actually slowly but surely been selling assets out of Seattle, the urban core in particular, but out of Seattle, because we're just concerned about the regulatory environment. So if you ask me the question, you know, what are the things that keep me awake at night? Right now, it's the regulatory environment. It's the burden coming on the landlord. You read about, you know, here's one thing that was maybe published, I don't know, 2 months ago about what they're thinking about for the legislature, which is coming primarily from some of the Seattle regulation. Ancillary fee limitations, winter eviction moratorium, which we already have, criminal history, not screening for back. And we actually have a building now that have data around the impact of that issue alone. First in time regulations, notice of intent to sell. So we have to actually tell people we're going to be selling stuff and give them a first right to buy it. Local rent control, state rent control, economic assistance, mandatory affordability. We have a housing crisis, Dylan. We're short in the state of Washington about 250,000 units. 250,000 units, that's where we're at, short. And I wonder why we've had rents go up so much. I wonder why we don't have enough affordable housing. At the end of the day, this is about a lack of leadership at the state level, and it's focused on a supply-demand imbalance. I mean, there's approximately, I'm gonna round this up, about 70 million, 75 million people under the age of 21 to 22. Where are they gonna live? That's the question. We're just a housing provider. We build housing, we invest in housing, and it's all about creating shelter for effectively, you know, our kids. So I'm actually pretty discouraged with the investment environment in Seattle proper. And I think a lot about, you know, the fact that Amazon just leased 2 million feet over in Bellevue. And they just said that they're not going to be leasing, was it 200,000 feet, 300,000 feet, and just letting a lease mature. I was chatting with somebody and they said that might be the trend for a lot of groups. They just said, we're just kind of done. It's just too much work and it's too expensive. So I don't know, Walt, if you know, in 22 it'll be better in Seattle proper. I don't know. Could be great in Bellevue. Could be great in Redmond and Kirkland and Bothell. Maybe Linwood. Maybe Ellensburg. You know, quite frankly.
Well, I haven't completely lost faith yet, but yes, there's a lot of we have a lot of issues to deal with here in the city. Yeah, there's no question.
It's a mess.
It is.
So.
Well, I mean, sales impact your portfolio. You hear from them, your clients. Are you seeing a slowdown across your portfolio of transactions, either net into your portfolio or net out of your portfolio in the last 6 months?
You know, sales, you know better than me, Dylan. Sales transactions are certainly down. Sales volume's down, I believe. I don't know what percentage it is.
A lot.
A lot, yeah.
A lot.
I know it's a lot. So yes, I mean, we have, there's a couple of portfolios on the market that are probably going to transact, and anything that gets put on the market, I mean, as you know, because of the interest rate environment, I mean, certainly values haven't been diminished from my perspective anyway. I guess it's hard to say what they would have been if we'd had strong rent growth, but you know, the cap rate environment continues to hold up values, it appears to me. We certainly don't have many clients contemplating selling. You know, it takes a business plan that this was the year they were going to sell. And there is some of that, but I would say in general that the environment is pretty much let's hunker down and see what next year brings.
George, from a transaction volume and number of sales, I think Goodman's pretty top of the leaderboard, at least in the last 2 to 3 months. How did those transactions go in a COVID environment? You guys, I think you gave me some stats at one point that you guys transacted maybe every 45 days. Maybe you can tell the audience how many transactions you guys do per annum, but how did transactions occur in the last 4 or 6 months compared to what your experience has been?
Yeah, no, you know, recently we sold one of our buildings to EQR, and that was new construction. And so for the most part, we sell our new construction product. So that was programmed and planned. We also finished renovating a project down in Kent, and that was planned to be sold. And then we got an unsolicited offer on an asset that was in a location that we thought would be good for both parties. You know, that's what I think a good transaction is. So we sold that one as well. And, you know, that one was a fine yield. So at the end of the day, we are in the business of building shelter and investing in shelter, and it does tend to cycle quite a bit. Right now, you know, if I have to really get a little more aggressive back on that leadership side, I'm going back to the idea that the investment market and the decisions we all make are really long term. If I look at what I'm going on right now, I was just looking at our statistics on our 5 development projects, that the average length of entitlement will be longer than the average length of time to build it. That's the first time that's happened in 10 years. Okay, think about that. I mean, is it really that hard? That's where we're at. And at the end of the day, when you're starting to think that way, deals that we're doing today, decisions we're doing today, we really won't see the manifestation of that until 2025. Okay, what's my regulatory environment then? Because that's our biggest challenge right now. When Microsoft, and don't quote me on this, but I've heard that Microsoft said one of their top business challenges is simply finding housing for their people. Okay, and they formed a partnership with Seattle Housing Authority to go out and buy. Nationwide, we're about 7 to 10 million units short. So, you know, I'm sorry to beat this horse up a little bit, but if, you know, and I agree with Walt on one thing is that I'd like to see the city turn around. I'd like to see the state turn around and really take this seriously. So at the end of this, I am going to be putting up on the screen, or Kate will, we haven't figured that out, but maybe I will if I can share my screen correctly, the top legislative races across the state that I'm recommending that everybody on this call contribute to that are advocates for property rights. And they are, you know, there's some Republicans, there's some Democrats, and then there's one statewide election. And so if we're going to change the outcome, we really all have to get involved. And I'm the first one to say that maybe I wasn't as involved as I should have been, could have been. And at the end of the day, here we are. So I'm turning it around saying I'm getting involved. And I'm going to advocate for the industry to get involved. So I'll put that up at the end.
That's great. Thank you, George. We're going to get into a little bit of forecasting, and I could probably, if I had the attention of all 3 of you, I could spend an entire afternoon on this, but I know everyone's busy because there's just a lot to come in the near future. One question a lot of people are asking about is the interest rate environment. It is driving some sales right now just because interest rates are low. It's driving a lot of refinance activity. Alex, crystal ball, where do you expect us to be in 3 months, 9 months, 12 months on the interest rate front? What are you seeing right now? Who's getting 3% interest rate loans, and how long is that going to continue?
Yeah, the Fed actually did me a favor this morning. I've been on the Wall Street Journal online all day because there's a reserve meeting happening now. And the guidance that they've said is that they're going to keep rates at zero until at least 2023. So that just came out, 15 minutes ago. I think that rates aren't going to go negative. At least they've given very clear guidance that they're not going to push rates into negative territory. So what it means for apartment owners is that the factors that are going to drive interest rates for the next 5 years are going to be competition among lenders. So right now, I think if you're at the really conservative end of the spectrum and you have a 65% LTV or lower loan and it's over 6 million, you're getting rates below 3%. I don't think rates are going to change on that side a lot. If you're doing a more aggressive loan and it's under 6 million or a more aggressive loan over 6 million, you're probably in the low 3% range, so call it 3 to 3.5%. And I do think rates there are probably going to get a little bit better. I think that over the next couple of years, as economic conditions improve and lenders get more competitive, more lenders come back into the market, I think you'll see probably some more tightening. And I think things will get better for people buying apartments just because there will be more aggressive terms. The agencies right now are still requiring reserves. That'll eventually go away. So I think that things will improve. I'd be surprised if on any side of the interest rate spectrum, though, that we see rates get more than 0.25% better than they are now.
Dylan, I didn't get to talk about lease ups and this interest rate environment obviously has an impact on that. The lease ups that we are performing and that we are tracking in the metropolitan area here. First of all, the absorption is down depending on which submarket you're in. At least 30% and in some areas 60%. So that compared to what our expectations were, so velocity of lease ups is down. Rental rates are typically down, but not in all locations. We have some suburban lease ups that are actually going pretty well, and we've heard of others that are going well. But the one thing that I hear from our clients and from other people out there in the market is that what's saving these developers right now that are stuck in this spot doing a lease up today is that their carry is substantially lower than what they performed. And provided they get their takeout or they get the product leased up and put it out on the market, they still think that they can perform their business plan. But that's a very fluid, very dynamic environment here right now.
The development side, George, you guys very active this cycle. I know it's thousands of units you've built. It's becoming a challenge to justify spending the entitlement time period and just the risk of ownership in Seattle. Are you guys still active on the development front in Puget Sound?
We are. We have about 1,200 units in some phase of construction. We have a 365 unit plus or minus down in Kent on Meeker Avenue that is now about 6% occupied and in a phased construction. We're about 3/4 of the way, 80% of the way completed. So it's going well. It's in a market that has a lot of demand because people are moving out of the city right now and the unit types are great. Everything else is in some sort of phase of entitlements with the exception of a deal up in Edmonds where we broke ground. And so I think just it gets down to that there's huge demand on the east side and that seems to be the safest market. And then of course, as a developer, you get stuck having spent, 25 months, plus if you include the time it took to find the land, call it 3 years. And if you use cash to buy your land, you're stuck with, call it 30 to 40 million embedded in the ground somewhere. So we'll probably end up finishing those, but will I start more? Well, I don't know that I will. Certainly not in the city of Seattle. I pass on every single deal. And south of, for us, it's tough to build south of Kent. We can't make the numbers work. And so if we build, it would be on the east side. And it seems like maybe that's a prudent way to go. That's where job growth seems to be going. And regulatory environment of Bellevue seems to be reasonable right now. So, and we are looking out of state. I mean, we've been looking in Arizona. We built in Arizona. We're looking in Phoenix. And Scottsdale. We have office that we built deals down in Vegas. We actually have looked at Reno for the very first time and actually are underwriting a deal there right now. So
the impacts of the political environment are real. It's having direct impact on people's decisions.
Well, look at the REIT. It went from 1.78% to 3.5%. I mean, depending on threshold, you know, the sale. Think about that and all the underwriting. Everybody, that really impacted a lot of people, and I think it's going to continue to impact people. And especially if you're trying to sell deals, people are just, the volume is way down, just flat out, it's way down.
Absolutely. Alex, from the development side, lenders, how are they looking at new developments? Are they as active as they were pre-COVID? And what's their outlook on funding development sites?
Not nearly as active as they were pre-COVID. I think it's more of I think the challenges with lenders now, it's qualitative rather than looking at the quantitative aspects of a deal. So the questions that are going to come up are, who is it? Who's building it? Has this person done it before? Do they have a strong balance sheet? I think things like track record probably count for a huge amount now. I mean, banks are really focused on doing business with existing clients, less comfortable taking on new projects in areas that they're not familiar with and with clients they're not familiar with. So I think for a strong development group that has a great track record, you're probably going to see terms that are comparable to what you were seeing before, and interest rates are great for construction as well as firm debt. But there's a lot more scrutiny on the sponsorship, and there's going to be more scrutiny on the economic fundamentals of the deal.
Thank you very much. Last question, I'll go to each of you. We always hear with economic cycles, this time is different. George, we'll start with you. Let's say we are the tip of the iceberg of the end of, and I think they called February the beginning of a recession, marked 128 months of expansion cycle. Is this time different? What's different? What's the same? And not a lot of time to answer all these, but real quick, when do you think we're going to see a dip back up from the doldrums we're in right now?
22.
And is this time truly different than the last time in fundamental ways?
The last time was a financial crisis, and it was an issue around liquidity. That's been solved. So there's a profound amount of liquidity and dry powder on the sidelines. And so right now we're bidding on a deal in Arizona, and it's already 10% over list. And I'm still saying maybe I should do that deal. So there's a lot of powder on the sidelines. This is actually a development crisis, because in order to build the next unit and to stop the bidding up of existing assets, and I'm thinking about equity there among people groups, then we need to build more units. And so this is the crisis. That's where we're at. And let me know when you want me to share the list of people I think everybody should send money to.
Right. We're gonna hear Walt pull out his crystal ball and Alex, and we'll get right to that. Walt?
I would say that the main difference between this one and last year, than the last one in 08, as George mentioned, obviously it was a liquidity issue. This time, it's not. In 08, I can remember the summer and fall of 08, it was like falling off a cliff. I mean, the music just stopped. And that was pretty much nationwide. I remember there was a few months where we thought we were going to be immune out here, but it was very short-lived. And this time it's really more it feels like it's more in slow motion from our standpoint, where it's been going on for 6 months. And so here we have George just saying, boy, this month collections have dropped a little bit, and his have a little bit more than ours. I think it's just portfolio, but we are in this inflection point where we're not quite sure what to make of it. And back in the last crisis, we knew what to make of it. We were going into the tank, and this time we're not so sure. I see positive comments and positive data points all the time. Literally every day I see positive data points, and then I see negative data points. So it's a real dichotomy this time of where we're going to land. And I think there's a reasonable chance that by next spring, if the scientists get the virus under control, I think there's a reasonable chance that we could still have a decent year the second half of next year. But obviously we have a ways to go to get there.
Thank you. Alex, what's different? What's the same? And when do you think we're back off to the races?
Well, I'm getting a little out of my comfort zone talking about equity questions, especially with this panel. I tend to focus more on just the debt side, which is easier. You know, I think that both the comments that Walt and George made make a lot of sense. If we have a vaccine, we can start getting things back to normal by 2022. It seems like that's what the time frame looks like to really kick things back off and maybe see more robust growth. I don't think we're in a recession at this point, but things maybe could change depending on how the markets go over the next few months. So it just seems like we're at a period where the economy locally and nationally has to reset itself. The people who are unemployed have to get absorbed back into the workforce. There's obviously the movement shift with people maybe focus more on suburban lifestyle as opposed to urban lifestyle. But I think that from an interest rate standpoint, it's going to be the same as it was in the last crisis. You know, the last time it took the Fed 7 years from when rates bottomed out in 2008 to start raising them again. So now they're saying it's going to be at least 3 years. I don't know. I wouldn't be surprised to see rates basically held at zero until 2025. So I think it's, or maybe longer. So at this point, the Fed hit the market with a bomb of liquidity, and they've committed to keeping rates low for the foreseeable future. And that's going to make borrowing cheap. Maybe it'll have other unintended consequences, but at least we know that liquidity is going to be there and debt's going to be there.
Thank you. Well, there's a lot we talked about we can't change. We can't change who was voted into council. We can't change a lot of these macro factors, and we certainly can't change our early corona response, but we can change the future. And I'd like George to talk a little bit about how we can do that. I think if you're on the line, you care about property rights. So I think everyone please stay on. George has a few minutes and thoughts to share with us. I think George may still be muted though.
There we go. Okay. At the end of the day, what I think I'm showing on the screen, correct me if I'm incorrect there, but these are the top property rights races for the state of Washington. And that Mark Mullet at the very top, moderate Democrat who's really kept rent control and in particular at check for the last 5 years, would recommend that everybody send him a little bit of money. And then you can see going on down there's a bunch of Republicans there, and that's because in general they tend to be a tad bit more supportive of property rights. But if you want to donate to what I would call moderate Democrats, there is this group called the Jackson Legacy Fund, and that is a group that supports the 10 moderate Democrats that have helped keep balance going in between the House and the Senate and any of the parties on both sides. So I would highly recommend a group donation to that. And then last but not least, Kim Wyman for the Secretary of State, because I think we're going to have some real struggles around how things are adjudicated there between groups. So this is my recommendation, and it's also the Washington Business Property Association, of which I'm a member of, and I would recommend people look at that because it's the property rights organization. And if it sounds like this is an infomercial or I'm trying to sell people on it, it's only because I think it's that serious. Otherwise, I wouldn't be saying it. But this is going to impact us as an industry, and it's all sectors. It's all sectors. So thanks for letting me share that.
Of course, and you don't have to do a screen capture. We're going to distribute this to everyone who's on the call. It'll be available, and if you don't get it for some reason, just email me. You should be able to reach me because I probably spam all of you at least once or twice a month with information on the market. But it's really important that we impact our future and we take an active role in it. I think we're coming up on the hour. There was a lot of good questions. One that came up I do want to field is George, you mentioned assistance programs. Some people had some questions about how you guys are helping with assistance and if there's any other publicly available assistance programs, or Walt, if you know any. That was a question that came up a couple of times, people wondering about how to help their tenants through this time.
You know, there is, I could certainly put a list together, Dylan, that you could send out with this. There are several really good local charities that I'd be happy to put a list together if you want to disseminate it.
That would be great. We're going to send a recap out to everyone, and that'd be really nice to have.
Yep. Well,
we've got just enough time to thank the panelists. Everyone is extremely busy right now. I really want to put a heartfelt thanks for the preparation all of you put into this panel discussion. I know a lot of people hit you up for your time and your expertise. Really appreciate the time you committed to our community of multifamily investors and people interested in the multifamily market. I want to thank my whole team. Want to thank Kate, who's behind the scenes to make this Zoom possible, because I was scared to death how to get 300 or 400 people on a Zoom without it crashing. So I think we've dodged a bullet with that, and want to thank her. Thank my business partners, Alex and Jared Anderson, for helping us run this team. To all of those of you out there are interested in learning more about us, please reach out. Would love to talk to you, but thank you very much. Wish everyone a great fall, a safe time out there for you and your families, and looking forward to working with everyone. Thank you so much for your time. Take care.